just very quickly as an introduction to myself then. So my name is Kamal Hassan. I'm the founding partner of a fund called Loyal VC. It's a 3.5-year-old global venture fund. I started my career as an engineer, did an MBA from INSEAD, and I've been and worked as a management consultant. Since then, I've been in the entrepreneurial world. I've been 20 years as an entrepreneur running different businesses. For 15 years of that, I was an angel investor. So I took what I learned about sort of running businesses and used that to start to invest in private businesses, which is a very large part of the economy, as you'll hear. And 15 years of that. And 7 years of that, I was also first running and then designing accelerator programs. So I've personally spoken with, engaged with, mentored over 500 entrepreneurs. So I know a little bit about private companies and how they work, and seen a lot of people make money, and a lot of people lose money. So I started to understand a little bit about what's involved in investing in these worlds, and happy to share some of that experience with you.
That's wonderful. It's nice having you on this platform, and we're all looking forward to hearing you speak and how you're going to manage to convince us to be investors and not just observers as women. Because women are always too afraid to invest their money. And since we do not have so much to spare, we're very careful that we do not put our money in the wrong investment. So we're looking forward to hearing from you how safe, how profitable, and how durable, if we decide to invest in your business, how do we know that we're safe and we can trust that we get the benefit of our investment?
Perfect.
So, yeah. Niti, you want to say something? No. So also, since you are also part of this, so that the women can see that it's not just Kamal, that he has an able assistant or team member in you. So I yield to you to say something while we take another minute to wait for them, then we start.
Thank you, Keiko. I would, while Kamal will cover a lot in detail, and I think what I would like to say is that, even between 2019 and 2020, the percentage of women being funded has gone down. It was as it is very low, it's gone down to 2.3%. So I think it's high time that we women come together and support each other in every way. And that would require us not only coming forth as entrepreneurs, as having our own startups, but also as investors. So supporting other women as well. So I think with that, while it will be covered in detail, the fact is that women teams, and when I say women teams, I'm not really excluding men, but a good mix of teams results in far better returns than only male teams. So I think with that in mind, I would pass the baton to Kamal for this event.
Thank you very much for that. I think we can safely start the event now. We are about 7 minutes behind time. So without wasting time now, I would like to start this event, if everybody is agreed. Okay. I would like to welcome everybody to this evening's event, organized by the Loyal VC, Kamal Hassan, and the Expert Professional and Business Women's Network International. My name is Princess Nwakego Ibrahim Pam, I'm the founder and chairperson of the EPBWNI International. We've been in existence for the past 8 years, and our initial mandate was for capacity building and empowerment. But we've moved our mandate to include financial freedom and financial independence for women, because you can empower a woman, and after empowerment, she needs to create wealth for herself, or she needs to be financially independent. And that is why we're happy to collaborate with Kamal Hassan tonight, for him to teach us how we can invest our income, and that we may be part of that 1 or 3% of women that have access to funding. If you're looking to be a startup owner or a business, you want to grow your business, I think Kamal's lecture today will lead us in the right direction of how we can invest or how we can improve ourselves as women investors. So for today, I would like to share with the women first my thought on why very few women are into investment. So I'll be sharing my screen, and just give me a moment to put up my presentation. Can you all see the screen?
Yes.
Yes.
Okay, I have intentionally taken the slogan of a new project I'm embarking on, and that is take action and be empowered. And like the introduction says, a goal without a plan is just a wish. Anton E. de Saint-Exupéry. That's what he said. If you have a goal and you don't have a plan, it's just a wish. It's just in your dreams. It will never be materialized. So the EPBWNI international mandate is to empower women. Not only do we empower them in capacity building, in their self-esteem, in their vision, we also want to empower them financially. And that is why we're looking for collaborators like Lawyer VC companies to work with the women that are members of the EPBWNI International. We're also looking at funding for entrepreneurship. So if you don't have funding, then you cannot sustain your business, or you cannot even start any new business. So forming a cooperative is also a form of funding that women can get themselves involved in. There's a proverb that says, it doesn't mean because you are not good in something, you cannot get better. You won't know until you try. So I'm challenging women that even though we feel we're not good in investment matters, we can get better being investors if we pay attention and if we intentionally learn and commit our finances to investment. That is the only way we can overcome this gap between men investors and female investors. So we go to the 5 steps to financial empowerment. Step 1, goal setting, positive mindset. I have to move this, and then cash flow, money values, and enjoy job. And then the second step is estate plans, personal insurance, emergency fund. Third step is pay off bad debts. Fourth, invest for passive income. Fifth, handle your wealth. These are 5 steps that are very difficult for women to go through. It takes very few women, at least 1% of women, to be able to maintain these 5 steps to financial empowerment. And why? Why is that? I'll go to slide 5 to highlight the reasons why women find it difficult to maintain those 5 steps. Women in businesses have challenges: one day child care, finding funding, sexism, lack of mentors, hand-in-hand mentors, and fear of failure. These are the major factors that makes it very difficult for women to attain the 5 steps to financial empowerment. And how would they overcome that? They'll only overcome that if they take the next step of how to maintain financial freedom. 1, set financial goals and prioritize. Set smart, specific, measurable, adjustable, realistic, and time-bound financial goals and classify them in short-term, medium-term, and long-term. 2, quality financial goals. Assess the future value of, I think I need to minimize my screen so I can see Okay, good. Quantify your financial goals to freedom. Assess the future value of each goal considering the inflation rate. 3, start saving and investing prudently. This is where we fall as women. This is where we drop the ball. This is where our fear starts. We start saving, and once there's an emergency in the home, we do not have the mind to turn our eyes away from our savings. But as men we hardly touch their savings. If they run into problem, the first place of looking for fund is not their savings. But for women, we use our savings to sustain the financial shortfall of our families. And so we will never get to the next step of investing prudently. We're always afraid. And the savings for us is like a last resort where we dip our hands into to help our families. 4, review your portfolio periodically. Monitoring annually helps you to keep a track of your investment to achieve your goals. It's only when you invest that you can monitor anything. But since we do not have investment, as I speak to the ladies, I speak to myself. If I have investment, then I'll have the habit of monitoring my investment annually to see how I can achieve my goals of being a female investor. And if I'm a female investor, then I'm financially empowered to also help other women. But because I'm not a female investor, I'm also in the pool of women looking for and seeking for funding. And so I'm not financially free. I'm still financially dependent either on the banks or on the grants on my spouse or my children. So I can only be financially independent when I'm able to dip into a reserve that I have saved up, not my capital, and to solve my problem. So 5, remain focused on your goals, no matter what the reasons are for the short time aberrations and distraction. Don't get swayed. That we do not, as women, we find it difficult not to get distracted by all the somebody say, oh, I invested in so company, and after a while something happened to my capital. You never get to hear the full story of what happened. So we hear half of the stories, and that discourages us, and that still makes us fearful in investing in all these investment companies. So we need to make up our mind and not be swayed by the negative information we get from people who have invested and it has not turned right for them. Finally, be diligent and patient. After making wise investment decisions, give your investment time to grow, as it helps in building up your desired purpose. This is very important. We live in a world where everybody is in a hurry to make money overnight. Nobody wants to see their investment grow over time. It's like this magical word that everybody thinks once you invest money, the next day you're rich. No, investment takes time. And once you're patient to see your investment grow, then at the end of the day, it pays better for you. You're not stranded, or your investment is not taken from the investment prematurely. And at the end of the day, you cannot see the benefit of investing. So how can women start making money? And this is where I come to the next slide, which talks about taking fear away from my financial freedom, having the audacity to ask. Women are always afraid. Women are always swayed by what people are saying about you. Oh, what would they say? Who is looking at me? Why are they going to take this decision? So when I was going to write my memoir, I knew, one, financial freedom was not at the back of my mind. What was behind my mind was legacy. But behind that legacy, I knew along the way, I was creating a passive income for myself. The money that comes from writing my memoir, Iyawo the Expert Pro, is a bonus to me, because the idea of writing that book was not to make money. But in writing that book, I have created a passive income for me that I may not be looking towards to spend, but I can use the income coming from this book to invest in other investment companies like that, which Kamal Hassan will be talking to us today. So you must create wealth for you to be able to invest. Because if you don't have wealth, then what are you investing? You cannot you cannot take a loan to invest, because then you probably be making the money for the person you have taken the loan from. So you need to create wealth for yourself, and then you invest the wealth. So when we listen to Kamal this evening, he'll be teaching us the importance of investing and being part of this great company he has started 3.5 years ago. So with this, I'll hand over to Kamal Hassan to hold us in his hand, take us step by step, teach us how to be trustworthy of the investment world, teach us the rules of how to be good investors, and teach us what are the good investments that we can put our money to. So thank you very much as I hand over to him, and I wish all of us the very best that this, I'll call it a workshop or training, will be beneficial to all of us. Thank you.
Perfect. Thank you very much for the introduction. So yeah, let's take you through things here. As you'll have heard, I've got a fair experience in entrepreneurship and investing in early stage companies. We are a global venture fund and global investors. And what that means is, you can see here in the map, we've got investments in 48 countries around the world. So let me just start off, because we are talking about financial freedom and investing. So if you will excuse the note in the middle there, but there are really, the way to think about your money is, if you want your money to roughly match the distribution of the economy, then, and really that should be the number one rule in investing to keep your money safe, is diversification. You want to really diversify to all sectors of the economy. When you look at it, it really splits out that there's about half your portfolio you want to be in what are considered safe investments. And this would break down around 25% in real estate. Many people own real estate through their own homes, but about a quarter of your wealth should be in real estate, another 20% in bonds, another 5% in infrastructure. And that's sort of the safe half of your investment, of your portfolio. This is something that no matter what happens, the money is always there for each of these individual assets. You then have about half your portfolio you expect to be in growth. If you leave your money only in safe, that means as you get older and older, you get poorer and poorer, because the economy keeps growing every year. And if you don't have investments in the growth side of the economy, then you are not going to participate in that growth. You're not going to have growing wealth to be able to support yourself. And here you want about a quarter of your money, public stocks, ETFs, around 20% of your money in private companies. Now, if you have a business already, of course, your business is a private company, and you'll want about 5% of that money in hedge funds or in crypto assets, things like that. Now, it is unusual. Most people would not recommend 20% in private companies. But the thing is, if you look at the economy as a whole, first of all, I mean, it's probably no surprise that over 99% of all companies are private. But what's actually interesting is that over half of the sales generated within the economy come from private companies. So they're generating over half the wealth. And you should really start thinking of this as an important part of your portfolio. Now, the way to invest in private, of course, if you want to invest in private companies, you can do so through private equity funds, through venture funds, directly yourself into businesses, starting your own business, or investing as an angel. And if we talk now about angel and venture investing, women participate in the angel and investing market much less than men do. So the result is that women are much less exposed to the growth side of their investments. And if you're less exposed to the growth side of your investments, then you will gradually get poorer over time relative to someone who has invested more in the growth side. And this is always on average. All investments go up and go down. If you look very specifically, women, of course, 50% of the population, depending on who you talk to, they control anywhere between 33% up to 50% of the wealth. That changes over time as people age. Women live longer and they tend to inherit wealth as they get older. But generally speaking, women are underrepresented in the world in wealth. If you look at the two activities I've talked about here, angel and venture investing, around 22% of angel investing is done by women. So you can see already fewer women take part as angel investors. And as was mentioned, so overall around 36% of women are entrepreneurs. And again, it depends. If you're talking tech entrepreneurs, it's about 36%. If you're talking about just business owners, small businesses, it can again be up to 50%. But in the VC space, which is a space I'm in, only 3% of VC dollars go to companies led by a woman. So if you actually look at the VC side of things, we've got very few women who are LPs in venture capital. I haven't found statistics for this, but just talking to colleagues, including colleagues who are women who run VC funds investing in women, typically they say that only about 10% of their money comes from women and 90% of it is coming from men. So women are not really investing in VC. By the way, VCs, 21% of investing professionals are women in venture capital funds, women like Needy. 79% are men like myself. And if you look though at how that money is allocated, you can see very little gets allocated through the women. So you really need to sort of look more closely at this. Now the question is, why am I talking about this? So I'm a man, what do I know about investing in women? Our fund has done a very good job of investing in diverse entrepreneurs. We have 10 times more women than the VC average. So 30% of our portfolio companies actually have a woman CEO. So if you look at why women don't invest more in venture and angel as angels or in venture capital funds, the typical reasons that come up are these. First of all, women will typically not invest in the space because of a lack of knowledge. Secondly, there are people who say women, people often think about women as being more risk averse, and that is not at all true. But if you look at what the studies say, women are actually more risk aware than men. Men will blindly go in and do things without thinking of the risk. Women will be much more intelligent about looking for where the risks are. So when it comes to investing, they require more information. If you look at why women are investing, they're often investing for security and comfort. And then reasons they don't take part in angel and venture investing is often it may be intimidating to be in the minority, and you may have fewer opportunities that you see. And if you're not looking for them, of course, you won't find them. So this talk, I hope, will address certainly the first 3 points about the lack of knowledge, helping you understand and sort of give you the information to be able to evaluate investments better, and to really just help you see a little bit more about the security, how to invest in a safer way to give you more security. Now, if we look at the development of private companies, and this is where the venture and angel space fits, private companies will start off, so someone like a Jeff Bezos, when he launched Amazon, entrepreneurs at this space will typically fund themselves at the beginning. It's very risky when you start a business, so you typically fund the money from yourself, and then as you move from an idea to a first product, you will get investment from friends and family. This is exactly what Amazon did. Jeff took $245,000 from his parents who invested in him as these sort of basically first investors in his business in 1994. If you're an entrepreneur looking for money, you often say, hey, I need money to get my business going. You will notice that it is easiest to get money to start from either yourself and or people who know you already. Because people who know you already don't have the same risk around investing in you in a person. So as an entrepreneur, you really need to start looking at this self-funding friends and family. If you go to a venture capitalist at this stage, it's very, very hard to get money, as I'll explain in a second. Once you've got that first product and are just getting to initial sales, then you start to go for angel investors. And of course, as an angel investor, you should expect people to come to you who've got some initial sales, just starting to do so, and certainly have a first product. Tom Alberg is a famous angel investor who, well, he's famous now because he invested $50,000 in Amazon back in 1994. From there, when companies are growing, you get venture capital. Kleiner Perkins, who put $8 million into Amazon in 1995. And this is really what venture capitalists do. They invest more money in already successful companies to help them grow. If you're an already successful company, you are who venture capital is for. If you are not already a successful company, you need to be looking over here to the left at angels, and if you're earlier, friends and family, people who know you. And then, of course, from there, the last thing you can do is the companies will then move on to either larger and larger VC rounds or private equity funding, or they will list publicly on the stock markets to sort of, you can see there's a Amazon listed in the stock markets in 1997. So this is really the space where we're all used to investing, is the public stock market. And all these other areas here are areas we can start thinking about investing for private markets to access the hidden half of the economy. Now, one thing to be aware of is, I talked about Amazon going public. So you said, well, great, I can just wait till companies like Amazon go public. And 20 years ago, that was true. If you look at Microsoft, if you look at Amazon, a 1986 launch for Microsoft, 1987 launch for Amazon, they listed very early in their process. And if you invested in them when they just listed on the stock markets, you would have made more than 2,000 times your money back. That behavior has changed recently. And you will see with time with Google, Facebook, Uber, if you invested in those companies when they listed publicly, you can see declining returns to public investors. So 40 times your money in Google, which is still good, 7 times your money in Facebook, 1 time your money in Uber. And the thing is, retail investors, if you invest only in the stock markets, if you invest only in ETFs, you don't have a chance anymore to access these private high growth tech returns. And if you want to access them, you must be an angel investor or invest in VC or PE funds. There's also this things called SPACs, special purpose acquisition companies. In Canada, we have the CPCs, but these are becoming more popular as a way to try to deal with the fact that companies are staying private. More and more larger and larger venture and private equity funds are investing. So SPACs are trying to come in and say, hey, we can bring these companies public earlier. It remains to be seen how big this is, but this is something to watch for. Now, if you're going to invest in this area of the economy, you do need to be aware that there's investor protection rules which close the private markets to the average investor. You need to be rich enough to invest in these markets in many countries in the world. Now, really the law, it's interesting that in 1933 Securities Act in the US was one of the first, but it basically said it's illegal for the company or the fund to take you as an investor, as either an angel investor or into their venture fund, if you are not an accredited investor. So the concept is you protect the public because you limit them to public stocks, but it also perpetuates wealth inequality. It makes it harder for poorer investors to access investments, which give them good returns. And they say you have to be accredited, sophisticated, or professional. And really an accredited investor means, are you rich enough? Now, those definitions range country by country. Many countries have them, a number don't. So for instance, China has no accredited investor law. That's one I know. You should really look up what are the rules in your own country to be an accredited, sophisticated, or professional investor. In the US, you need to have liquid assets of $1 million, income of 200,000. EU, assets of €1 million, regular invest 50,000 euro amounts. Singapore, it's 2 million Sing dollars in assets, 300 Sing dollars in income. Korea, it's 500 million won of assets or 100 million won of income. In India, it's 5 crore of liquid assets income of 50 lakh rupees. So you can see that there's very similar rules in many countries in the world, and just make sure you're aware of those. Now, if you're going to look at investing in venture capital, many people get scared by it because deals are individually risky. And if you're investing in a small business or starting a small business, you should be aware that most deals will fail. And the deal failure rates look really scary in venture capital because 65% of venture capital funded companies will fail over a 10-year period, compared to only 20% for private equity and less than 10% for public companies. And if you look at them here, why would anyone do it? Well, yes, 65% of companies fail, but the ones that succeed, 31% will give you a median of about 3 times your money back, 3.5 times your money back, which is enough to cover all your losses. And then you say, well, why would I do it? Well, it's because 4% of companies give you more than 10 times your money back, and this is where your profit comes from. So you can see right away, if you want to do angel or venture investing, most of your profit will come from a very small number of deals, 1 in 25 deals. And I think you can already see where this is going is, as you do this investing, number one, you want to really keep your eyes out for companies which have the potential to be big successes. But number two, you need to do a lot of these investments. And in fact, you can see what happens. If you do only 5 venture investments, you can lose all your money very easily. Or you could make quite a lot of money. And the same is true if you're an angel. If you increase the number of investments up to 15 or 20, well, you can start losing money, but you're highly unlikely to ever lose all your money if you get this many investments done. And if you start to increase this to 50, up to 150 investments, you can see that as long as there's no as long as there's no strong bias in your investments, you are statistically likely to never lose money. More importantly here, look at what's happening with the median returns here, the average return you'll get. You can see the more investments you make in venture and angel, the higher your average return goes. So it goes from something like a 6% average return if you make only 5 investments, up to something like a 13% average return, which most people would agree is quite good if you make 150 investments. So this is the magic of diversification. Diversification, rule number 1, when investing, make sure your portfolio is diversified. And for the private company part, you need to make sure it's really diversified, because that sort of magic, call it 100 investment number, is really important, because you need to not care if 5, 10 deals fail for you. You need to not care, because you have so many investments that a few of them will do well and make up for all of the others. Now, if you're going to invest in this space, diversification is a partial solution, okay? Individual deals are risky, so you have to do a lot of them. You will need to also watch out for 3 other things. First of all, you need to do diligence on these investments. These are the returns if you invest in real companies. People will lie and mislead, so you need to do what's called due diligence. And angels, there's a study out of the US which said angels who do over 20 hours of diligence on their investments, on each investment, have double the returns of those who do a lot lower diligence. So if you're going to invest in something, spend a few extra hours to look into it and really understand what's there. Ask the difficult questions, really try to figure out what's in that investment. The next thing you will need to watch out for is negative selection bias. You should always be asking yourself when you see a deal, why is it available? Because the deals that people feel are best or get funded first. The math I showed you works only if you're investing sort of in companies randomly. But if you invest only in the deals that nobody else wants to invest in, your returns will probably be worse. So really try to see how are you getting access to unusual things. The third thing to be aware of if you invest in this space is there are long times to exit. Your money is going to be locked away for 10 or more years. So this is something which you are investing for your retirement, for your children's university, things like that. It's not money you're investing to spend right away. Now, investing within a powerful network can really help you with the first two things. If you share a network with people, that helps with diligence because they have incentive to not lie to you. Our fund invests, for instance, in alumni of the INSEAD Business School, and that's one of the big risk reducing factors we do, is we know that people, if they lie or cheat us, they're not just lying or cheating us. We have, for instance, I mean, the deans of INSEAD on downwards know us, so they know they're potentially hurting their reputation in the network. And the other thing is negative selection bias. Your network can help you find good deals before they go to market. If you're the entrepreneur, this network is your friends and family equivalent, where you can bring deals to show people and make them feel more comfort around you. None of this will help with long times to exit, but it will certainly help improve things in the investment. And here's the stats, just so you can see. It takes a median of 7 years, for 7 to 8 years for companies to exit from time of investment to either listing on a public stock market or for the company to be acquired. My best investment, an investment which gave me 30 times my money back, it actually took me 14 years from when I made that investment to when I got the money back again. And companies also take a fairly long time to fail. If you invest in a private company, it'll take you 3 to 6 years to see if the company failed. So your failures come early, your successes take longer. Now, why would you do this? I've been telling you all the downsides. Well, you do it because, among other things, it's fun. Here are 4 portfolio companies. We have a cultivated meat company out of China who's busy growing fish in a sort of in factories, in the sort of chemical factories rather than actually killing the fish. We have Beta Store, an e-commerce company out of Nigeria, which is helping the small kiosks you see at the side of the road restock from their mobile phones so they don't need to shut down and go into the market. They can order just like you order on Amazon, only it's B2B, good prices, wholesale, so they can actually make money selling them in their kiosks. We have FBB Bio, a medical technology company out of the US. We have a clean tech company out of Norway run by Charlotta, whose software to help companies reduce food waste. So you can see there's a whole range of things, and there's obviously some good sides to it. You just want to do this in a very risk-aware manner. Let me just stop there for a second and open things back up to you to see if you have any questions on this first part. I can get into more details about venture and angel investing, but let me just see if you have any questions on the first part, the things we've talked about so far, on investing in general, on venture and angel, etc. And I am going to see, I've got a couple of questions which came in ahead of time. So let me just answer a couple of these. Feel free to put your questions into the chat or also to unmute here. Celia has a question. Celia, do you believe that women are also more interested in investing in alternative business models to the startup unicorn VC model? Are alternative models that balance profit and purpose, champion democracy, and put a premium on sharing power and resources more credible investments in the eyes of female investors? One of the nice things of being an investor is you have power over how your money is used. You get to vote with your wallet of where you want to put your money. And there are many different kinds of investments. We do see a growing interest in impact investing, in social purpose investing, yes. I don't have stats on how much women do that versus not. I think one of the things which is important to remember, if you do want to invest in private companies, you have to always remember that private company is risky. Private company investing is risky, and companies will fail. The reason this works, the way you make it safe is by doing so many investments that the ones who succeed pay for the ones who fail. And if you're going to do that kind of investing, it's really important to ensure that your investments, that there is a probability that some of those investments will give you very high returns. So as long as you're in something which is a company where you're profit sharing, then it makes sense. I have seen a lot of people who say, hey, can you support my for-purpose business through giving me a loan? And if we're successful, then I'll give you back your money plus 20% interest rate. And the second someone's saying, you can hear that and you go, oh my goodness, I'm supporting all these people. Yes, but if you make 20% interest rate, that doesn't cover the two other businesses that you've supported who are going to fail. So you need to look at things like that and say, yes, let's be smart about this. I want purpose. I also want to make money. Now, I do know with our own fund, for instance, 80% of our portfolio companies address one or more of the UN Sustainable Development Goals. But no matter where you're investing, you're trying to look after yourself as well here. So feel free to take a part of your money, which is for charity, which you can do whatever good you want with. With your investing, absolutely do social purpose investing. But I would say with social purpose investing, think of yourself and look at this both as an investment and as a way to make money, and ensure the investments you make have the potential to make money. You talk here about sort of the unicorn VC model. I agree entirely. Unicorns, the best way to avoid unicorn math is don't do these late stage high growth tech mega VC funds, because they're all about the unicorns. But if you start investing in earlier and earlier stages, if you invest in a company when it's valued at $1 million and that company sells for $10 million, that's 100th the size of a unicorn, 1% the size of a unicorn. It's nowhere near a unicorn, but you've made 10 times your money back. You've managed to cover off a whole bunch of losses and still make money. So I would say that's the way to do it. Think about the earlier stage, smaller valuations. And if you can invest at small valuations, you don't need unicorns. Modest successes will be fine. Yes, go ahead.
I have a question. As an investor, as a new investor, if I want to invest in a loyal VC now, so if I hear correctly what you're saying, if I want to invest, then I should not just invest in, let's say, Google. I should invest both in Google, Facebook, Amazon, any other, maybe aviation, transportation. I spread. Okay, let me put it this way. If I have $10,000 to invest, it's not prudent for me to put all the 10,000 into investing just in Facebook. I should be able to go ahead.
Yeah, no, agree completely. In fact, the math of diversification, I said you need to have sort of 100 private companies to be able to have a good starting point for diversification. In the public markets, you need to have at least 30 companies. So first of all, you would never invest just in Facebook. You need at least 30 companies in your portfolio. The easy way to do that is to buy an ETF, an exchange traded fund, who already invests in a diversified number. So absolutely. And that gets back to the beginning, which is asset allocation, which is, yes, your growth money, you want 25% of it. So you want half your growth money, 25% of your assets total to be in ETFs, public companies. And then for something like a loyal VC, I mean, something like a loyal VC is interesting because it's massively diversified. If you invest in our fund, you are buying over 200 companies right away. Whereas yeah.
That was my next question. I wanted to make it plain for people listening. So now, if I decide to invest in loyal VC, what you're saying to me today is that investment, if I invest $10,000 into loyal VC, it means I've invested into more than 200 companies. So yes, my investment is secured.
So absolutely, that's why we do the diversification, is so that, look, out of our 200 companies, I think 40 of them have failed so far. We keep adding new ones, but we don't care. When you have 200, when 40 companies fail, if you've invested in 50 companies and 40 fail, that's a big problem. If you've invested in 200 companies and 40 fail, you don't really care. And in fact, our financial returns have been excellent for the fund, even while 40 companies fail. This is the magic of diversification. It really works.
I think this is the story you should tell the women. They just want to know what to do. If the fact is lost in the explanation, then we might leave this workshop not knowing the steps to take. So
yes,
from what you've said up to this point is, if we are interested in investing in lawyer VC, you are telling us that the chances we have of making our investment successful is high, because we won't be just putting our eggs into one basket. We'll be spreading our investment into so many companies that is sustainable, and at the end of the day, we still can make gains on our investment, because that is the message the women want to hear.
yes, absolutely.
And that is the area that frightens the women. A lot of women have monies for investment, but they're so scared. And so your message to us today should be that tells us what we should do, practical step for us to do to become loyal VC investors. And you are telling me today, if I put my money in this company, I have access to 200 companies and my investment is safe. That should be the message.
Yeah. Now, by the way, of course, you're welcome to reach out and contact either Needy or myself if you're interested in our fund. We are regulated. We can only take accredited, sophisticated, et cetera, investors. So make sure you know the rules for your country when you contact us, or we can help you chase them down and find them out. I wish we could make it open to everyone. We can't, just because of the law. And if you don't like these laws in your government, talk to people.
So different countries have different laws that affect the kind of investment company that you run. Is that what you're saying?
Different countries have different laws which affect the kind of investments that citizens in those countries can make.
Okay, as a Nigerian now, do you have any idea what the laws are for me if I want to invest into loyal VC? Or do I have to go and find those laws myself? Or you do the due diligence for us?
We can help you find them. I've looked at the laws for Nigeria before, and I think Nigeria is actually one of the countries which doesn't restrict investment. So you may not be restricted as a Nigerian, whereas an Indian would be. But we could talk about that afterwards. I can't tell you for a fact.
Okay. So, sorry that I'm recapping. I want women to really understand what you're saying so that it will be more, they can take practical steps to it. So, investing in loyal VC is a very profitable venture, because you have, once we invest in your venture, we have access to more than 200 companies. And since we have access to 200 companies, the possibility of making gains on our investment is secured. And then we need to find out the laws that govern us as citizens of our countries if we're allowed to take part in such investment, correct?
Yes, absolutely. And look, if you're interested in us, and you're a reasonably wealthy person, reach out and we can certainly help you. Don't feel scared that, oh my goodness, I need to find this out. This is just general knowledge for you. It's easy to find online. It'll take you 20 minutes. Talk to friends, talk to lawyers, etc., people you may know. But you can find out this information reasonably quickly. In fact, your government, they put it all online. It's their job to tell you what the laws of your country are. So it's relatively easy to find quickly. As I mentioned, for instance, if you're living in Korea right now, I found that just before getting on today. I just Googled accredited, sophisticated, qualified investor Korea. And I found out a link within sort of the third link down, which told me, hey, if you're in Korea, the rules are this. And so it's something which you can typically find in about 5 minutes of Googling what the rules are in your country. And yes, loyal is a good way to do that, to get that diversification. You should diversify with everything. Loyal is a great thing to include in there. You should consider how you diversify your startup investing, your ETFs. You should always have multiple ones because you're trying to avoid all points of risk, all points of failure, by making sure that no matter what happens anywhere in the world, that your money is protected. You still have wealth lying around in different corners, in different places, in different ways.
Thank you, Kamal, for being generous. But the main idea behind having this workshop with you is to assure the women of the safety of their assets or their investment. They are looking for reliable investment companies to invest their money. So
yes.
If we leave it open for them to go and research and find investment companies to do that, we will still be at the status quo where we are, where women, like Niti said, we're just 23% of women or 2.3% of women that are engaged in investment activities. So this is your flaw. Today is for you to invite people to invest in loyal VC because you are able to manage our investments for us. You're able to teach us, because apart from investing in loyal VC, it's also a part of training. Because if by the time we invest with you and we become knowledgeable to the nitty-gritty of angel funding or investment, then we can venture with knowledge. We're informed in taking other investment adventure. But for now, we want to play it safe. We want to play safe, knowing that you run this thing, and from what you're saying, it has been successful. Our investment will be safe with you. And that is why we have this platform, for women to leave this platform knowing that they can call you or Niti if they have money stuck away somewhere and they want to invest. There's the guarantee that their investment will be safe.
I mean, yes, that's exactly how we run it, to try to minimize investing. It's funny when you talk to someone in the investing world, they never want to give a guarantee. So what I'm telling you is principles for how you invest, principles. Look, I've got my own money in this fund, and I'm not allowed to invest in any other venture fund other than my own. So I am running this venture fund to actually protect my own money. It's like, when it's your money, how would you run the fund to protect things? How do you run the fund to both make sure you have a chance for returns and to make sure you're protecting money at the same time? And protection is diversification, and a chance for returns is really, I mean, we have a process, a system we run to generate returns, which is to make small investments in companies initially, get to know them over time, spend many months in diligence to really be sure that when you're investing, you know what you're doing, what you're taking on with the companies. And then we invest small amounts in the very best of those. And it's common sense. When you invest in people you know really well, because you've spent months getting to know them, and you only put money in the best of those, you get better returns. And that's what our fund does. The other thing our fund does, which is very unusual in this space, is that it is an open-ended fund where you can trade in and out every quarter. So we give you the chance to say, after 2 years, hey, I would like to spend some money on a second home. I would like to spend some money on whatever family thing comes up that you would like to invest in, a new car, I don't care. But the thing is, most of the time, if you invest directly in a private company, you have to wait 10 years to get your money back. As I mentioned earlier, with our fund, you can trade in and out after holding the fund for 2 years. So it is very unusual that you can invest in private companies, diversified globally, and be able to trade out in 2 years. And those are things that we do. Some people say the ability to trade your money out is another form of safety or security, because it means your money is more accessible, and that gives you more flexibility to be able to handle things, whatever comes up. Now, Loyal, there's actually a famous fund called Sequoia, who just started to do this with all their funds 3 months ago, because they say it's best for the investors and best for the companies, and we agree, and that's why we're doing it.
Mustafa has his hand up since. So
yes,
if we
Mustafa, please.
Yeah, thank you so much for taking the time to speak with us today. I appreciate it. I have a kind of a few questions. One is, what do you think about angel investor syndicates, and how I can do a due diligence in general if I'm based out of Cairo, Egypt, and I want to invest in South Africa or Nigeria, for example? Like, how can I do a due diligence?
So the advantage of angel syndicates is exactly that. And angel syndicates is when a bunch of angels get together to make the investment together. And when you're in a syndicate working together, you can share the due diligence. So you can actually say, hey, let's get 10 people together to do due diligence. And hopefully, if you're investing in South Africa, you have at least one member of the syndicate who is from South Africa, who can then do the diligence on the ground. And one of the things Loyal does is we have 500 advisors around the world. So if we ever need someone on the ground, we can reach out to one of our advisors. Having said that, how do we do due diligence? A lot of due diligence can be done by simply asking for all the paperwork. Ask for paperwork behind a company. If a company is sales, ask to see their contracts. If a company, there's a partnership, ask to see the contracts, read the contracts. If they've raised multiple rounds of investment, take a look at that. Take a look at the cap table. Many countries, you can go online to find out sort of public things. Look at a public profile, look at LinkedIn profiles, see if people's LinkedIn profiles are credible. Look online to see if the company has a history. There's a lot of different things you can do. So for instance, I was looking at an investment fund someone asked me about yesterday. And when I went online to look at the investment fund, with the company which was offering the investment fund, when you went to the team section, it didn't list any people anywhere there. So they didn't say who the people were behind it. When you tried to check the company, Google it online and find the profiles of the people on LinkedIn, they didn't have profiles on LinkedIn, no profiles on LinkedIn for the company itself. All there was one website and nothing else. So you want to sort of look for all these supporting documents. And as you look for and find all these supporting documents, it becomes too hard to be someone who cheats, because it's too much work to deal with someone who says, oh, can I see this? Oh, I can see this. If they built up a public profile, do this. And as you start looking for all these things, remember, you only need to find one hole in the story to say, aha, this is cheating going on. Spend the time looking and you will see if you can find that one hole. And it's just, whether you're local or remote, it's easy to do all those things. But I mean, hey, if there's an address for the company, look at Google Maps and see what shows up. I remember one company I was looking at ages ago, there's supposed to be this wealthy investment fund out of Mississauga. And I just went on Google Maps and I looked at the address of the company, and it was somebody's house in the middle of a residential district. Well, that doesn't look like a wealthy investment fund. So there are all sorts of things. These are the sorts of things you can check if you're doing due diligence. And if you have multiple people investing together, then you can share it around. So each of you does a few hours work.
Okay.
Thank you for that. One more question, if you don't mind. Any recommendation for communities or newsletters where I can get more information about, like, what companies are booming, coming up, potential unicorns, other than Forbes and Wall Street Journals? I just need something that is easy to read, easy to understand, and easy to access.
So the biggest concern you have when you're looking at trying to get sort of hot ideas of what the next fun thing is from a journal or a newsletter is you always worry about this negative selection bias that I was talking about earlier. What's going on so why are these companies in the promotional newsletter or journal? Does that mean they're the best companies? Probably not. There's a whole bunch I haven't heard of. Maybe too many people want to invest it because everybody knows about it, et cetera. That's part economics 101, supply and demand. If everyone wants to invest in something, it's expensive. If nobody wants to invest in it, it's cheap. So I would advise a lot of caution on that. If you find something through a newsletter, do the research, do the diligence, find out what's behind it. But I would really worry about things. I would worry a lot about things which show up in a newsletter without deeply understanding what's behind them. And I would think about, how do I access deals in a way which doesn't have bias and which is showing me normal everyday businesses, not just a few hot things. But look, you can find good deals that way. I'm not saying you can't. There could be interesting things in there. Try also, one of the advantages of using professional investors is professional investors don't invest based on story and excitement. They invest based on assessments and diligence. And for instance, I talked with I don't know how many of you followed the Elizabeth Holmes story. Her startup, of course, which went bankrupt, the name will come to me in a second, out of the US. But I remember talking to someone who was a investor in a venture capital investor who invests in life sciences companies. And he said, they saw the company, they asked a few simple questions. Elizabeth Holmes didn't have any answers for them and sort of dodged around the questions, and they just walked away because it's like, hey, I have questions on the science. You won't answer those questions. I'm going to walk away. And yeah, so that's the advantage of professional investors, because lots of people looked at the story and said, we love the story. Theranos, thank you. Lots of people love the Theranos story. And it's like, great. So as an individual, the Theranos story looks good. But if you have a professional who spends time looking into it, or if you want to spend the 20 hours yourself looking into it, you will start to pull the holes. And you didn't have to be a professional investor. Theranos, if the angels in Theranos had said, let me ask this, let me ask this, let me ask this. And when they say, oh, no, that's handled, don't take that as an answer. Just say, please explain it to me. I don't get it. Can you please explain it to me? Can you please sort of talk me through these things? And those are the sorts of things where the diligence is really important if you're going to invest. So either do it yourself or find someone else who will do it for you.
Okay, I have a question.
Yes.
Usually we get this question from many people that before getting into investments or investing into a fund, is it important for the investor to have invested in certain companies as an angel investor?
No, not at all. In fact, if you want to get into this space initially, a fund is a great way to do it. It's the same thing when you're in the public market. Start off with an ETF, an exchange traded fund, before you invest in a single company like Amazon or Facebook. And it is exactly the same way in the early stage space and the angel venture space. If you're just starting to get into it, it is safest in any investment area to start with a diversified fund, learn from the diversified fund, and from there, if you want to do further investments directly, do them afterwards, but always start with a fund and then move on to individual stocks from there, would be my general advice.
Thank you.
Now, we were supposed to wrap this up in an hour. We've run a few minutes over.
Yes, so I was just going to say, if there aren't any more questions, if you check the chat thread, you see Kamal Hassan's details, his email address, and the website. Please, you can contact them directly and Niti, and I'll definitely be following up with you, Hassan, to see how I can bring myself to the point of investing without fears. So for those of you that have been on this program, thank you for making time to join us. We want you to take that one more step of faith. If you have some money stuck away in savings, please take the courage to invest them in companies that can fetch you passive income returns. One more question, Hassan, though, I wanted to ask. For how long can you leave your money in an investment? What is the time period you can leave your money in an investment?
So it depends totally on the investment. With Loyal, it's very simple. We have an open-ended fund. You could leave your money in there for, I mean, it's designed so that you can leave your money in there for 10, 15, 20 years and just keep collecting payouts. We're making a payout right now to our investors, which is about a 5% payout this quarter. So you can just leave money in to collect payouts, or you can trade out, as I said, in our fund in as little as 2 years, but it depends on each investment. That's why people like public markets. As public market, you can trade in and out the next day. Private markets is a little bit harder, but still, that's one question to ask is about holding period, and I've given you the answer for our fund. Okay,
thank you very much for that. So thank you, Niti.
Kego, I would just like to add to all the women who are participating here. So for me, this was the first investment I ever did. outside of, or let's say in the alternative investment sector, outside of the market, the public markets, outside of mutual funds, outside of shares and stocks. So this is the first time I did, and it's been approximately 2.5 years, and I definitely vouch that I think it's one of the best decisions that I ever took. So yeah, over to you, Kego. Thanks.
Thank you very much. It's always important for us to hear from other women who have ventured into the investment market, and that gives us courage to follow your footsteps. Definitely, I will follow up to see how I can be part of that investment so that I can experience it myself, because speaking from head knowledge is not the same as having experienced it, knowing the pitfalls, knowing the successes, and knowing the failures. It's only in that way can we be proper mentors. Can we actually sell what is real and not what is superficial or aesthetic to people? We can, with clear conscience and with diligence and honesty, say to people, this does work. Since I've been part of this investment, this and that has happened to my life, so that people can actually have the faith to invest their money without fears, because fear is what is depriving women with income from investing. Because once they get wiped out, they do not have a fallback and they cannot start from the scratch. So if investors have this behind the mind, they will find a formula or a method of reaching to women and encouraging them and assuring them that their money will be used diligently for the purpose in which it has been invested in their companies. So thank you very much, Kamal Hassan. Looking forward to having another session with you if the demand comes from the women. And thank you, Niti, and thank you each and every one of you that have taken time to join this program. Do have a lovely weekend, I think, and see you soon. And please join our program. I'm also working with other women to establish a fund called African Women Entrepreneurs in Diaspora. This cooperative is aimed at accessing funds from the African Development Bank, European Bank, IMF, because they have about $54 billion available for women entrepreneurs to have access to, which this information, I don't know if a lot of women are aware of it. So I'm setting up this business for African entrepreneurs in diaspora to have a voice in accessing the fund, because we are marginalized in the sense that because we're outside of Africa, we are not qualified to apply for Commonwealth scholarships, fundings in Africa. And we're here in diaspora, we're also in the minority, we do not have access to these funds. So the aim of this cooperative is to ask that we should not be penalized for not being within the African continent, but as Africans, wherever we live and wherever we are, we should be able to access these funds that are meant for us. So if you're interested, you can reach out to me so that we can, as women, access all the funds available for us to make our businesses work, to set up our businesses, and to impact our communities. So thank you very much and have a lovely day. God bless you all. Thank you, Hassan.
Thank you for hosting.
Thank you.
Now.
Thank you for hosting. Bye.
Have a lovely day. Bye.
Thank you. Bye.
Thank
you.
Bye. We love you.
Workshop. Thank you for the information shared.
Thank you. I hope you overcome your fear and we try little by little. Let's start investing little by little and overcome our fear. Well,
by the way, we just made an investment offer to we already have 3 investments in Nigeria, but we just made our 4th offer to actually a woman Nigerian entrepreneur. So
yeah.
Thank you.
Thank you.
Yeah.
So I'm sure a lot of the women will reach out to you. I'll keep having programs on financial freedom for women to break away from their fear and the inhibitions that stops us from investing in huge investment companies like yours. Thank you
Perfect.
again.
Thanks. Okay.
No,
Bye-bye.
God bless. Bye, everyone.